If you are a homeowner, you may have received a letter from your bank recently informing you that your mortgage interest rate is going up. So how much higher will the interest rate going to be? Will it go up to 5%? And for homeowners, what can you do? If this is the topic that interests you, continue watching on. Hello, I'm the property strategist, Steven Chong. Appreciate your early thumbs up. So why do the interest rates keep going up? Now we all know that it's because of the US Federal Reserve raised the interest for 6 times this year to fight the rising inflation. But the US interest rate rising, just let it be lah. Why must Singapore follow? This is the first thing that I would like to share in today's video. If the US increase the interest rate, Singapore don't want to follow also can. But the consequences can be deadly. I will explain why. Not only the interest rate increase on bank loans, but also the increase in US government bond yield. Think about it. If the return on investment in US is much more higher than what you have in Singapore, would you rather put your money in US? If that happens, people will exchange Singapore dollars for US dollars to invest in US bonds, right? Which are guaranteed. Exchange Singapore dollar to US dollar means people don't want SGD and prefer USD, right? In other words, the demand for SGD drops. And what will happen? SGD become weaker and SGD values drop. As a small island nation, Singapore lacks natural resources and rely a lot on the imports. Imagine if our SGD value drops, that's it lah. Import goods will become more expensive and eventually make the inflation even worse and out of control. And when will the high interest rate last? As of today, some banks already raised their fixed rate package to 4.5%. How high will it go? Will it hit 5%? Okay, this is a tough question, man. Comment below and share your thoughts. In my opinion, high interest rate will not last forever. It is just a handbrake to slow down the inflation. I foresee next year in 2023, the interest rate will still keep going higher but slower lah, and will start to come down in 2024. But why 2024? I will cover this in the end of this video. High interest rates and inflation are biting hard into our family household budget. Many people like me also feel the pinch already. So what can you do to minimize the impact of high interest rate? First, you must understand your budget and plan for your future in advance. For example, if you own a HDB flat and plan to buy an EC, a new launch EC in the near future, do not pay off your HDB outstanding loan. It's better to keep your cash and CPF because you can use it for your new launch EC down payment. Because I have seen too many people wanted to buy a new launch EC, but their money was used to fully pay their HDB flat, making them cannot afford to buy the new launch EC without selling their flat. If you are still not clear about your future, feel free to reach me and let me plan the best for you. Whether you own a HDB flat or private property, how young are you, and your budget, I always have a plan for you. Now, if your fixed rate package already expired and you are not planning to buy any new EC, then you may consider to pay off your loan. You can either do a full settlement or partial settlement for your housing loan after the lock-in period. However, I don't recommend you to do it for your car loan and renovation loan because there is a prepayment penalty. Furthermore, you can always use your CPF OA to reduce your housing loan amount. Take note that CPF OA is giving out 2.5% interest only, and if your fixed loan package today is charging you 4.5%, I think it's much more worth it to clear as much as possible using your CPF. But if you plan to buy a property soon, you can park your money with Singapore saving bonds. Their recent offer interest rate was higher than 3%. Although the return is not that high, but it is guaranteed. And most importantly, you can always withdraw the money with just 1 month's notice. Besides that, you can also park your money in the best saving accounts with better interest rates such as OCBC 360 and UOB One account. If your property is not fully paid yet, you can refinance it after the lock-in period. Usually after the lock-in period, the interest rate can be higher than the market rate. So it is always good to review your housing loan every 2 to 3 years so that you can sign a better package by paying the lower interest. That will save you a few $100s every month. In addition, you can also refinance your housing loan to pay until 75 years old instead of 65. With the 10 years longer loan tenure, your monthly installment will be reduced. For resale property, you can always refinance after the lock-in period, whereas for the new launch property, you can refinance after TOP. Buy a new launch can be either BTO, new EC, or private property. However, there are pros and cons. For new launch, you pay the housing loan based on the actual progress on site. When the construction works reach a specific milestone for the unit that you buy, the developer will call for the certain payment from your bank. Then you pay the monthly installment to the bank, which means the initial milestone, your monthly installment can be as little as few $100s every month. The much higher monthly installment only kick in when you collect your key, which is TOP a few years later. In other words, you pay lesser mortgage interest during the construction period. Take note that you cannot take any fixed rate package for the new launch property. The most commonly seen is the 3-month SORA average plus a spread. And hopefully, by the time you collect your key, the interest rates will drop below 2%. Hopefully, In addition, you don't have to pay for the property tax and maintenance fee during the construction, and that helps you to save a lot of costs. But that's provided you have a place to stay during the construction period. And if you want to find out more about the new condo launch in 2023, you may contact me via my WhatsApp at 9188-7652. Once again, I'm Steven Chong. Hope to see you soon. Bye. Hey, wait, did I promise you something?